So Tesla reports their earnings today. Over the last 3 quarters of 2022, they've actually been beating their earnings. However, I don't know if their luck is going to run out due to the fact that interest rates are high, recession is pretty much around the corner, and people have less of a demand for those vehicles. And these are all coming from Elon Musk himself. So what we're going to do in this video, folks, is we're going to investigate what the company's doing right and what they're doing wrong on a financial basis and figure out the intrinsic value of this company. If you're like me and you're a long-term investor, earnings calls, dates, they're, you know what, I just take them as a grain of salt, because if my time horizon is exceptionally long, I won't get too flustered if the earnings are well, if the earnings are bad, because you know what, the time horizon, anything can happen over the long run. What's important though is whether you're paying a proper price for this business, and you don't want to be overpaying for such company. So I have Tesla loaded up here in the stock spec software. This software is grading the company a 5 out of 10. Now that's based off their financial statements. So take a look at this, guys. On their price to earnings ratio, they have on average had a price to earnings ratio of 627.62. That is astronomically high, folks. We like to find companies that have a price to earnings ratio of 22.5 and below, because we don't want to be overpaying for their earnings. A company that's trading at a very high PE ratio means you are paying a premium for those earnings, and we don't quite like that if you are a long-term investor such as myself. The current ratio is also sitting at 1.46. It is not terrible. The software is docking off a mark because we like to find companies that have a current ratio of 1.5 and higher. That would indicate to us that they have enough assets on hand, plus a little bit of wiggle room to cover those liabilities. Third, the return on equity average is in the negatives, sitting at 11.55%. However, in the trailing 12 months, it has been sitting at 31.86. That was our high numbers, folks. So Tesla is one of those companies that I've analyzed before, and it's been in this transitional stage. Prior to 2019, this is a company I would not even take a look at, but now things are getting quite interesting. Another docked point is their share dilution. Over the last 5 years, Tesla has been increasing their share count by 2.71%. Now, as a shareholder in this company, I'm personally not, but if you are, you shouldn't be happy about this, because you're essentially sharing more profits with more people. Ideally, we want to find companies that have been buying back shares, granted if those shares are cheap, or at the very least, keeping the share count the same. And last, their return on invested capital average is currently sitting at 2.37 on average. So that is incredibly low, but if you bring it over to the trailing 12 months, it is currently sitting at 25.11%. That is phenomenal. So there's a huge gap here with this company. You're seeing that the profit margin on average is negative 2.79%. Now currently it's 14.95% in the trailing 12 months. The return on invested capital, as we indicated, is way higher than the 5-year average, and the return on equity is way higher than the 5-year average as well. This is the turning point for Tesla, and these are numbers that we love to see. Even in the company metrics category, as we go down these columns here, look at their EPS. On the trailing 12 months, it's 3.61 with a lower PE ratio of sitting at 39.87 compared to the 5-year average price earnings ratio sitting at 627, with their average EPS being 0.12. The numbers don't lie. 5 out of 10 is not a great score, but they are doing a lot of things right. And as I said, they are in this turning point, that being that their EPS has been growing, as we've shown. Their debt to equity is low, sitting at 22%, meaning they are generating and leveraging their capital through equity and not through debt. Also explains why the share dilution is up. Usually if you have a low debt to equity ratio, they are upping the share dilution, so they would be diluting you. So that's the caveat to that. But the net income has grown, the free cash flow has grown, and the revenue growth is up as well over the last 5 years. So Tesla as a company is looking pretty good. I'm hoping to see a lot more green on the board. Now, with the earnings coming out after the market closes, we'll see where this company lies. Currently, at the time of recording this video, the stock price is $142.10. We've seen a massive drop off in stock price. Take a look at this. The 52-week range hit a high of 384.29 and a low of 101.81. Now, listen, obviously this video is coming up before the earnings, so if the stock price drops, then or goes up, to be honest, I'm not too concerned, because listen, I understand the economic conditions that are pretty much being put forward. What we can do though as long-term investors is to price out this company utilizing a margin of safety going forward to kind of factor in this slow economic or this economic turmoil that may be affecting this company in the future. So in the price analysis section here, I've done a 10-year analysis with revenue growth numbers, taking a huge haircut to what they've shown in the past, along with profit margin staying around the same, along with a free cash flow margin. So pretty much I've kept the same numbers for that profit margin and free cash flow margin, but the revenue growth, I've took it down a lot. I've taken it down a lot just to factor in the slow growth that may happen over the next couple of years. Coupling that with a conservative price to free cash flow ratio and a PE ratio that's more favorable than we've shown here on the trailing 12 months, desired return of 13%, what we should be paying for this company today. And folks, if you're enjoying the video so far, hit that like button and subscribe button. It means a lot to me, means a lot to the channel. So take a look at this, guys. Current price is $142.88. And now the average calculations comes out to be $71.70. Regardless, if the earnings come out and the stock price drops, you should be happy about this, because that is going to mean that it's going to come further down to a more fairer value. Now, with earnings coming out, if the company does well in the earnings, you'll see the stock price rise. And obviously, if it doesn't do well, the stock price will drop. Now, what I'm going to be doing, folks, is I'm hoping the stock, obviously they beat the earnings. That would be ideal. So the short story of Tesla is this: currently it is overvalued at $142.88. It needs to fall in half for it to make sense for me and potentially a lot of other investors that are looking for the long term. But that's the video. If you enjoyed it, hit the like button and subscribe button, and we'll see you in the next one. This software here, if you like it, head over to the links in the description box below to try your 7-day free trial. If you enjoyed this video, folks, make sure you don't miss out on what I believe is possibly the best stock to own for 2023 in this video right here. You don't want to miss out.